Well, it happened. The Fed gave us 50 basis points. But what does this mean, especially when it comes to mortgage rates? In the next several minutes, I want to walk you through the market's reaction to this news, unpack what the Fed had to say, and specifically explain what this means for you. First, the 50 basis point decrease. This is a significant move because it's the first time the Feds have reduced the federal funds rate since 2020. That brings the Fed funds rate down to within their target range of 4.875. For a long time, it had been sitting at 5.375. Now, it's important to remember that the federal funds rate does not have a direct correlation with mortgage interest rates, but it's the interest rate at which depository institutions like banks lend each other money overnight to meet liquidity requirements. That said, while 50 basis points is encouraging, the Fed also told us not to get used to the steep cuts and that they would monitor financial indicators as they approach the remaining months of the year and into 2025. But how did the markets react to this news? Well, last week was a little jittery following the Fed's statement. Mortgage-backed securities specifically, which drive mortgage interest rates, are still dissecting the news. Meanwhile, the stock market seemed to react positively to this news. But why? Yes, we got 50 basis points cut from the Fed, but we need to remember that mortgage bonds and mortgage rates will not respond in lockstep with the Fed. They're two different things. The important question we need to ask is this: does the bond market think that the Fed has inflation under control even after this cut? So far, the bond market is accepting this, and the bond market thinks that the 50 basis point cut will not reignite inflation. Now, while this means good things for mortgage interest rates, I want you to also remember that we started to see mortgage interest rate reductions this year. Several months ago, mortgage interest rates were up to the 8% mark, and now we're almost at 1.5% to 2% lower than that. Progress has been made already, and we expect that trend to continue, which is great news for home buyers and owners who want to refinance. That said, let's go a little deeper and talk about the Fed comments and thoughts and what they mean to us. The Fed has a dual mandate, and that was cited in the Fed statement. The aim is to have stable prices, which they define as inflation being at 2% or less, as measured by the core PCE, and a, quote, maximum employment. But what does maximum employment mean? The Fed did say that the focus will be more weighted on the employment side moving forward. You see, the Fed is confident that inflation will get to 2% at some point in the future, and they understand that there are lags to consider when measuring inflation. In other words, it will not happen overnight. But for unemployment, the Fed previously said that unemployment had been moderated, but they are now saying that unemployment has slowed. Why the change in this position? Well, after the quarterly census of employment and wages, also known as the QCEW, revised its employment numbers, the market saw that a reported 818,000 new jobs did not actually happen, and the unemployment rate bumped up to 4.2%, which historically is still a pretty decent number. And also in their comments, the Fed said they will continue the quantitative tightening. And what that means is that the Fed will continue to run off the balance sheet by electing not to reinvest some or all of its principal repayments when securities mature. Now, that's a mouthful, but I did an entire call around this in 2020 called Rates, Real Estate, and Recessions, where I explained what this means in detail for the overall markets, but also for us. So feel free to check it out. Now, the Fed stated that the economy is solid, but let me walk you through what quote-unquote solid means for them. You see, the summary of economic projections is very important on the forecasting side. At the Fed meeting, all 19 Fed members anonymously post where they think the Fed funds rate is going to be this year and in the future. But they also post other projections on other parts of the overall economy, including unemployment. So looking at this chart, you can see the voting results. For the 2024 rate, there were 2 who voted for no more cuts. Although it's anonymous, we know that these were Bauman and Schmidt. Now, what's interesting is that although these two were not in favor of cuts this year, they are in favor of steeper cuts in the future, based on where the dots are for the next 3 years. They do see the slowdown coming, but they don't believe it will hit until next year. As you can see, there were 9 votes also for a 50 basis point reduction, which out of the 19 members makes that the median number and what we can expect potentially over the next few months. Now, based on their recent forecast, we will see potentially a 50 basis point cut this year between November and December. But of course, they can revise these numbers based on new economic reports. The Fed is also forecasting another quote-unquote potential 100 basis point cut over the next year. They expect inflation to stay where it is at 2.6% for the rest of this year, but they project inflation to decrease to 2.2% by the end of 2025. And if you remember, their target is 2%. They don't expect inflation to hit the target until 2026. Unemployment rates are sitting currently at 4.2%, and the Fed expects to actually increase a bit to roughly about 4.4 throughout the year in 2025. In the second chart, you can see the Fed unemployment rate forecast. 16 out of 19 members did not see the unemployment rate going above 4.1%, as indicated by the dotted blue line, but it did. And after the Fed cut the Fed funds rate by 50 basis points, the Fed members have really shifted their projections. Federal Reserve Chairman Powell stated that the Fed will continue to remove restrictions and cut rates, although no more than 50 basis points at a time, so that they would be surprised if unemployment jumped above 4.5%. Looking at GDP, it's currently at 3% on an annualized basis. For the developing country, a healthy GDP is roughly about 2 to 3% annual growth. So while the Fed forecasts that our GDP will slow, it should remain, according to them, at 2% this year and next. The Fed did answer questions about recession during their press conference this week. Basically, they do not see a recession coming. They said that spending and growth have remained resilient, but I think that what we're failing to see here is the actual deficit spending that Americans are dealing with. You see, Americans are going more and more in debt with credit card balances going up and savings going down. People are using money they spend in the future on purchases now, and there's limitations to that. The Fed did state that the 50 basis point cut was a commitment to not falling behind, and it does not think we are behind the curve, which is encouraging, even though the market did not obviously like this statement. As I've already mentioned, Powell is also not expecting a 50 basis point cut in the future. They are front-loading the actual 50 basis point cut of September 18th, but here thereafter, they're going to continue to maintain an eye on the overall economic indicators to determine future cuts in the future. Overall, the news from the Fed last week had a rippling effects across the financial markets and real estate. And our stance still remains the same, and it's twofold. For the home buyer, if you're thinking about purchasing a property and a unit meets 85% of your criteria, it might make sense for you to take that property down, since we have not only seen spike of buyer activity over the last few weeks, but inventory continues to remain low and competition high simply because of supply and demand. For those of you that have bought over the last 2 to 3 years, this might be a perfect time to reevaluate what these rate reductions could mean for you, not just on a monthly basis, but perhaps in consolidating additional debt. As always, regardless of your scenario, don't hesitate to reach out to us via email so we can build a model according to your specific needs. Thank you so much.